Hey there, savvy investors and squeeze-savvy traders. Welcome back to the channel where we dive deep into the fascinating world of how to borrow stocks and short squeeze mechanics. Today, we're putting a unique spotlight on a name that recently popped up on our proprietary screener due to some truly eye-catching metrics, NCT. We're going to dissect what makes NCT stand out in the hard-to-borrow landscape even with its current dormancy. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Sure, NCT ticker on screen. Let's talk about NCT. This is a microcap company, and its sector is currently listed as N/A, which often indicates a highly specialized or perhaps even a less active entity. Now, for the critical numbers from our latest scan. Display price action numbers. Looking at the recent price action, NCT shows a plus 0.0% change today, a plus 0.0% change over the last 5 days, and a plus 0.0% change over the last 30 days. Similarly, the volume data is striking. Today's volume sits at 0 shares, with the 30-day average volume also at 0 shares, giving it a relative volume of 0x average. Yes, you heard that right, zero trading activity in recent history. This makes NCT a truly unique case study for understanding how to borrow dynamics even in a dormant state. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it such a crucial metric for us? When a short seller wants to bet against a company, meaning they believe its stock price will fall, they first have to borrow shares from a broker to sell them. The cost to borrow is the annualized fee that short sellers pay to borrow those shares. Think of it like interest on a loan, but instead of cash, you're borrowing stock. This fee can vary wildly, from fractions of a percent to hundreds, even thousands of percent. When a CTB fee exceeds 100% annually, it means holding a short position becomes incredibly expensive, potentially costing more than the entire value of the stock itself over a year. A high CTB indicates that there's either extremely high demand from short sellers to borrow the stock or, more often, a very limited supply of shares available to borrow. Both scenarios are red flags for potential short squeeze conditions. Why this stock is hard to borrow right now. Now let's connect that back to NCT. Our hard to borrow screener flagged NCT with an astonishing annualized cost to borrow fee of 677.5%. Highlights CTB percentage that is an extremely high fee, indicating that despite its current zero trading volume, there's significant difficulty in finding shares to short or a strong existing short interest. The estimated float for NCT is a tiny 0.3 million shares. Highlight float size. A low float means there are very few shares available for public trading, which inherently makes a stock harder to borrow. While information on shares currently available to borrow and CTB momentum for NCT isn't readily available, the combination of 677.5% CTB and a 0.3 million share float is a potent mix that lands it on our radar. Our internal composite squeeze score for NCT sits at 42.5 out of 100, a respectable score, especially considering its current dormancy. This high CTB suggests that for any short seller already in NCT or looking to get in, the cost of maintaining that position is astronomical, creating immense pressure. Squeeze mechanics explained. So, what does it all mean in terms of a short squeeze? A short squeeze happens when the price of a stock starts to rise significantly, often unexpectedly. This upward movement puts pressure on short sellers, who start losing money as the stock goes up. To limit their losses, or to meet margin call requirements, short sellers are forced to buy back the shares they borrowed to cover their positions. When many short sellers try to cover at the same time, this sudden surge in buying demand, especially for stock with a low float like NCT 0.3 million shares, can rapidly push the price even higher, creating a self-reinforcing cycle. This forced buying is the essence of a short squeeze. However, it's crucial to remember a high cost to borrow like NCT does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the company's fundamentals are poor and are willing to pay a premium to stay short, waiting for a downturn. Dilution risk check. One critical factor that can negate even the most promising short squeeze setup is dilution. Dilution occurs when a company issues new shares into the market, increasing the total number of outstanding shares. This influx of new shares can effectively flood the market, suppressing the stock price and making it much easier for short sellers to cover their positions, thus offsetting or completely negating any potential squeeze. For NCT, we've performed our dilution risk check. We found no recent dilutive SEC filings such as SMIN S1s, SMIN S3s, or 424BS in the last 90 days. Furthermore, there have been no recent reverse splits for NCT in our look-back window. This lack of recent dilution or reverse split activity is a positive sign for any potential short squeeze thesis, as it means the existing float of 0.3 million shares hasn't been significantly expanded recently. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given NCT current year volume, what should we be watching for? The primary catalyst would be any resumption of trading activity. Look for any sudden, even minor, increase in volume. Even a few thousand shares trading could be significant given its current dormant state. Show empty candlestick chart, any movement in price breaking the current plus 0.0% trend would also be a key indicator. Zoom in on price axis, keep an eye on any updated data regarding shares available to borrow or changes in the cost to borrow should it become available. With a float of only 0.3 million shares, even a small surge in demand could have an outsized impact on price. This is a stock to monitor for awakening from its current slumber, as the underlying hard-to-borrow dynamics are exceptionally strong. So, there you have it, NCT, a microcap with a 677.5% annualized cost to borrow and an ultra-low float of 0.3 million shares, yet currently exhibiting zero trading volume. It's a fascinating example of how underlying barometrics can signal potential even when a stock is dormant. While its current inactivity makes any imminent squeeze unlikely, these hard-to-borrow conditions create a highly combustible environment should any buying interest emerge. As always, do your homework, understand the risks, and trade smart. If you found this deep dive into NCT and hard-to-borrow stocks insightful, please hit that like button, subscribe for more unique educational content, and let us know in the comments below what other stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.